Welcome to Kitco News. I'm Niels Christensen. Gold market is in an uptrend, but one of the most bullish banks on Wall Street is warning investors not to expect record high prices this year. Here to talk about his outlook on gold and the precious metals markets is John LaForge, head of real asset strategy at Wells Fargo. Thank you very much for joining us today, John.
Thank you for having me.
Okay, so let's just jump right into this. Your latest outlook, published late April, it was interesting. You noticed more technical reasons to cap gold's rally this year. What are the factors that you're actually looking at to drive gold in 2020?
Yeah, most look at fundamentals, and understandably, the main fundamentals are going to be QE to infinity, which this year in particular is interesting. Record low interest rates, the amount of negative yielding debt that's starting to pile up globally. Those are the main factors. I wouldn't say that gold's being driven at all by COVID-19 or those types of fears. I think what we're looking at now is this environment where many investors are looking at gold as a hedge against the money printing and low interest rates. And the idea that, frankly, we don't know what the consequences are. We live in these financial times where when's the last time we saw negative interest rate and this amount of balance sheet explosion by central banks? The answer is never.
Well, I guess like 2008 is our closest reference point, but I mean, even this pale, like it's so much bigger. So what do you like? Is gold sort of the new bonds then in a low interest rate, negative environment?
That's a big part of it. And sometimes that gets missed in the equation. Gold has periods where it does really well, and then other periods where it really just kind of muddles along. Those periods, though, where it kind of muddles along, it's because often it's competing against bonds, particularly long-term bonds. So the safe asset route, usually a long-term bond will have a 2, 3, 4% yield. And if you try to compare it to gold that doesn't have a yield, the longer term investors, those looking for a safe haven, will at least turn towards bond because you basically get paid to wait. Right now, with near zero interest rates or less than 1%, gold is a viable alternative globally, not just in the U.S. There are many investors out there that don't trust their governments to keep the fiscal houses in order and even the monetary houses in order. And if they want a safe haven and bonds aren't paying them anything, hey, at least gold is agnostic towards a government. It's not tied to a particular government. You can take it and cross borders if you'd like.
So obviously, inflation, low real interest rates are going to be good for gold in the long run. What about the deflation risks that we're seeing in the short term? We're seeing really slow economic growth. The worst activity since the Great Depression. What are your thoughts on the downside risks for gold?
I've often seen deflation as a mild positive. And I may be the only one that sees that. But the way I kind of look at deflation is eventually central banks and governments fiscally are going to have to respond to deflation. Deflation historically, you have job losses. The economy starts slowing down. So what is the answer to that by governments? It's typically to pump more money into the system. It's QE to infinity. So I've actually seen deflation as kind of a trigger to get gold going again. I don't necessarily see it as a negative. I think your best environments for gold are typically very high inflation or sometimes even hyperinflation, or frankly, even some deflation, because in both of those cases, usually the end result's going to be a positive for investors flocking to gold.
We've talked about QE to infinity, massive money printing. Do you think the Fed has more ammunition? I mean, is this it? What's left to drive gold prices higher?
Yeah, I think the Fed still has more tools in the toolbox, and they're going to keep going as they need it. As an example,
Hmm.
there are many areas of the housing market they really haven't helped out or propped up, and there's a lot that probably has to be done there in terms of bond buying. And this may be the time where the Fed starts pushing back on the government, Congress,
Hmm.
to say, "Hey, you need to do
Hmm.
your fiscal part." We're kind of at the end here, but for the time being, they're not out of bullets. But you
Hmm.
do kind of wonder at this point, are they pushing on a string? They can put more money
Hmm.
out there, but are we going to get some type of economic benefit from that? That's a big question mark.
So the big question, I think a lot of people are sort of wondering, and Powell's really pushed back on this idea: negative interest rates. Do you think they go negative?
We don't. No, it's not
Hmm.
my call at Wells Fargo. That's Brian Railing and the fixed income guys. But I see their argument. We talk about those types of things, and no, we haven't seen that it's really benefited anyone. You do have countries like Sweden, as an example, that have gone to the negative side, realize there's truly no economic benefit. So what they're trying to do is come back out and go back to the at least neutral to positive.
Hmm.
So there
Hmm.
aren't many examples to really look at, but the countries that have done it, you can tell they're looking at it saying, what benefit did we get from this? So I don't think the Fed wants to go there. I think they prefer to keep as many bullets open as possible. So they don't really want to go there.
Hmm. So we've talked about fundamentals. The technicals, and this is what you said in your report is more that's more holding gold back in that um, breaking up to a new all-time high is a very big deal, and it might take a couple runs. So I mean, what do you expect sort of by the end of the year, and do we see when do you think we see record high gold prices?
Probably next year.
Hmm.
We're kind of running out of time. Today's June 1st, so we're already kind of making our way through the year, and we're already up double digits with gold, which is a good
Hmm.
year for gold. But the piece that is often missed with gold is it is a commodity at the end of the
Hmm.
day. And what commodities do is over long periods of time, I call them super cycles, they tend to move together as a group. They tend to be going
Hmm.
up year after year together. That's a super cycle
Hmm.
bull. Or eventually they end up crashing and find their ways into a super cycle bear, which is where we are now. So
Hmm.
gold is no different than any commodity right now. It's stuck in a bear market. No commodity today is anywhere close to where the highs were 10 years ago. So gold is
Hmm.
fighting that trend. So we really need to see gold break out of the 1900 range convincingly. And then it could get
Hmm.
really interesting. But I wouldn't expect it, Niels, until next year sometime.
Early in the interview talked about gold's replacing bonds. I'm sort of wondering, how does this impact portfolio allocation? Everybody sort of says the general rule is to hold 5 to 10% in gold, but if gold is the new safe haven, should that allocation be a little bit higher? What are your thoughts?
Some make that argument. We're not right
Mhm.
now. We're still comfortable with the standard percentage that anyone's comfortable with at the individual level. Everyone's a little
Mhm.
bit different.
Mhm.
But what
Mhm.
I tell you is where it could change is if we do break out of 1900,
Mhm.
because then you could have potentially the sky's of the limit scenario with all this money printing and low rates.
Mhm.
So
Mhm.
at
Mhm.
that point, we'd reconsider it. But as long as commodities are still in a bear market, and gold included, this super cycle bear, we'd keep the percentages pretty much where you normally would have them.
So last question then, talk a lot about gold, but silver. Silver's making a sort of a big move now. We've seen the gold silver ratio fall below 100. What are your thoughts on silver prices?
We like silver and we like platinum. They're two
Hmm.
alternatives to gold. They're much cheaper. They have not had the run that gold has. But if we're
Hmm.
in this extended period of preserving wealth, we think precious metals generally will start moving up together. It's
Hmm.
clear that gold is the patriarch of the family. I would say if you want to hedge against that unknown future, I would at least own some gold. But the other two are such great bargains, silver and platinum, that I'd add those to the portfolio as well.
Well, thank you very much for your thoughts. It's been a real pleasure talking with you today, John. Thank you.
Thanks,
Thank you
Niels.
very
You
much for
too.
your time. Thank you very much for watching Kitco News. For the latest in the precious metals markets, go to kitco.com. Stay safe and stay healthy.